averages were telling you to buy right then, way back there where it started. Had you bought back then, you could have jumped into the overall market around 7,700 or so, and of course you could have ridden several of the waves. Now you're going to also notice that these these short-term exponential averages, they will kick in and they will give you a bearish signal on some of the smaller corrective moves. These are more the intermediate type moves that I talked about. You're not going to see those on the long term, the 100 and 200 period. They'll kind of cut that noise out. But the shorter term swings, these shorter term averages will pick them up. And, almost every time, unless you're in a sideways move, when you get a moving average cross, you've got a continuation of that trend. That's pretty simple. Simple enough, I think Mama could do it. All right, let's come over here and talk about my third tool, my secret weapon. My secret weapon with moving averages. Here's how it works. You can use your moving average as a support and resistance area. In other words, I've spent the last 4 classes teaching you about how to draw support and resistance, and now I'm telling you that there's a tool in your computer that will help you. It's not a replacement, but it will help you. It will help you identify where those trend line support and resistance areas should be. So here's how it works. If you're above the moving average, then the average will be working as a support. And if you're below the average will be working as a resistance. Pretty cool. That's the way you would normally see your trend line too, isn't it? If you're in an uptrend, you're typically looking at the support trend line. And if you're in a downtrend, you're typically looking at the resistance trend line. Well, now I'm just suggesting to you that if you're in a trend, if you're above the moving averages, those averages will tend to work a lot like a support. And if you're below the average will tend to work a lot like a resistance. We're going to use the short-term exponential averages for this. And as the stock falls down towards the average will act as support. As it drops through the average and bounces back up, the average will act as resistance. It's really that simple. Take a look at this. By the way, this is an important bullet. Let me really highlight this. I use the short-term averages for this. The 100 and 200 do not work nearly as well for this feature. I use the short-term averages for this. All right, so just remember that. Let's take a look at this big Netflix trade as it was losing steam back here in 2010 and 11. Look at our nice trend line we had. Okay, there's your trend line. Now watch what happens when I put our averages on here. Oh, look how close that 50 period is to your trend line. Look how close it is. And more importantly, you did not have to wait for the trend to shape up to get that trend line. You started getting the 50 period moving average shaping out the angle of this trend well before you could have ever drawn the actual trend line. And that's typically the way it works. At the beginning of a trend, your moving averages are way more practical than any trend line that you can ever draw. That's why you don't see tons and tons of trend lines on my charts. If I've got a trend line that needs to be drawn, I'll draw it. But most of the time, I can get away with using my moving averages to kind of give me the structure that the trend line would normally be relied upon to give me. Now, that's pretty cool, isn't it? Robert, you can do that. I know you can. All right, now, let's kind of pull this together. We've just talked about 3 key benefits of the averages. We've talked about using it to identify the trend. We've talked about using it to time your entry with a buy or a sell signal. And now we've just talked about it to help define your trend angles with support and resistance. But there's other ways that we can use them as well. We can use those angles that we get from the kind of using it as a trend line. We can use that as a place to set our stop. And this, by the way, you need to know, is my primary way of setting stops. Once I drop above or below, Once I drop below or bounce above a moving average, my stop is triggered. I almost always set my stops in a trend related to the moving average. It's a very, very powerful way to do it. Let me give you some examples here. Typically speaking, if we were to look at this CSX trade here, once you break below your support, where would your stop go? Well, it would need to go above it here. Well, watch what happens when I put my moving averages on. Put my averages on. Well, before I go there, let's just think about this. So we drop below CSX. We set our stop up here. Now, as CSX drops, how far down do we want to move the stop? Well, I don't know, because you don't know how far it's going to retrace, right? So if you're like most people, as the stock moves in your direction, you come behind it and you're like, I better tighten it up here. I better lock in as much profit as I can. But you have no idea where the trend is going. Then if you actually see the bounce and you're still in the trade, you might move your stop down to $23 or so. But it's kind of a hard idea. Now watch this here. When we put the moving average on here, I've got 3 places I can set a stop. I can set the stop above the 50 period, and as the stock is falling, I keep adjusting my stop, and I'm just tracking with the trend all the way down. That's one way to set the stop. Another way is you could use the 20 period. This one is one of my favorites to use. I typically will use the 10 or the 20. Now, we would have gotten stopped out right here. If you got back in the trade on the gap down, you would have stayed in the trade until you got stopped out right here. The benefit of using the 20 period is you don't have all that room. Look at the price difference. Very similar at first, the difference in 24 and maybe 24 and a quarter. But as you start to really get the momentum going down here, you're looking at a stop at 23 and a quarter versus a stop at, about 23 and a half or so, 23.75 maybe on the 50 period. Now, what if we went down and we used the 10 period? Watch this. We could actually set our stop above the 10 period, and we would have been stopped out right here. We would have avoided some of that headache. As the trade jumped back on, we could have put our stop back in. We would have stopped out right down here. Get back in the trade when it bounces, and when it gaps down, we'll be stopped out right here, and then you're back in the trade. This is how I set my stops. And yes, every 2 or 3 days, you should be adjusting your stop, if not every day. And what I'll do is I'll take my stop in a bearish trade. I'll put it just above the averages. And in a bullish trade, I'll put it just below the averages. Look over here on the bullish side. We could use that 50 period, and we just stay in the trade forever until we finally stopped out over here. If you're using the 20 period, you weren't in the trade here. You have the cross happening here. You're setting your stops up in through here. You get stopped out there. Maybe you got back into the trade. Maybe you didn't. Maybe you got back in here. You're getting stopped out up here. In other words, if you use the smaller average numbers, your stop is going to be a little bit tighter, a little bit closer to the price action of the stock. If you use the larger moving average number, it's going to be a little bit looser, and you'll be in a longer-term trend, typically speaking. I had something I wanted to tell. Oh yeah, don't use less than 10 period for this. Don't do this technique with a 8 period or 5 period. Don't do that. With very rare exception, those really fast moving averages, you'll just be getting stopped out all the time. The 10 period is kind of about the threshold of where you want to go. So you need to see that. Gary says, which one makes more money? Gary, all things considered, they're going to be about the same. The difference here between using the 50 period and the 10 period is your exposure to risk in a reversal. So notice the difference here over on the right side. If you start setting your stop based on the 10 period, you had 1, 2, 3, 4 trades. Versus if you did it with the 50 period, you only had 1 long trade, right? But the difference is your exposure over here on the 10 period, down here at the bottom, you got your stop set at $20. If you're using the 50 period, your stop set at $22. Well, on a $20 stock, that's 10%. That's pretty big. And so, Gary, it just is a matter of how much exposure you want to have there. Now, Leon mentions commissions. Leon, I don't worry about commissions. Your commissions, relatively speaking, should be a very small percentage of your trade. If you're paying more than $10 for a stock commission, you're paying too much. You should probably be trading, paying closer to $5. But if you're the Options Express, you're probably paying $10, and that's okay. And Leon, in a trade like this, hopefully you're not trading one share. You're trading several shares. With an option trade, a $10 commission won't eat you up. And so you shouldn't worry about that too much. Now, if you're trading with a broker that's charging you $50 or $100 for a commission, Leon, you should worry about it, and you should switch brokers immediately. But, typically speaking, I don't worry. I don't make trades based on commission. I make trades based on what's smart. Make sense? That's what I'm going to do. All right, let's talk about the weaknesses. Nothing is perfect. No trading system is perfect. If it was, we would call it the perfect trade. There is no perfect trading system. There are some really good ones. And so let's understand this. Moving averages are not the perfect system. They really only are going to work during a trend. You need to remember this. They only really work during a trend. In a sideways move, you're going to get triggered into a lot of false signals. Be aware of that. Okay? You're triggered into a lot of false signals. Before placing a trade based on the moving average, I would like you to make sure you've actually got a trend. So you say, how do I know I've got a trend? And here's one of the little techniques I'm going to teach you. It's called moving average angles. Let me show you how this works. All right, you're going to like this. So let's take a look over here. In a strong trend, here's what you're looking for. The stock is above or below the moving average, and you've got a steep angle to that move with line separation. Gary was asking about line separation earlier. In a strong trend, the stock is above or below the average with a steep angle and line separation. In a weak trend, the trend angle is flat. In other words, the averages are moving sideways, and the averages are moving through the price action of the stock. And I could put another bullet on there for you, Gary, and say that the lines are converging upon themselves, and with the moving average lines. And when you have the moving average lines converging, you know you've got a problem with your trade. That's why I say I can get you out of these trades earlier than just the simple system itself. But the simple system itself is profitable. So notice what happens over here. We've got the separation happening, and this is a sustainable trade. Over here in the middle, where the stock was moving sideways, notice what's happening. During this chunk, look at how the 10 and the 20 are moving downward, and the 50 is moving upward. Those are converging upon themselves. This is not a strong, sustainable move. Even once we had the next little move that came in here, that was a moving average cross, moving bullish again. Notice we did not have strong angles. That 50 period is pretty much going flat. The 10 and the 20 period, very weak angle. It's kind of like if you're looking at a clock, that's maybe like 230. And of course, what happens? It just does the exact same thing. We've got averages converging, totally sideways right here. You see, they're just kind of weak angles. Now, this one right here was starting to get some momentum, but it wasn't strong. You had the 50 period going flat. The 20 period was kind of starting a good angle. The 10 period was a decent angle, but then very quickly they started to converge back up. This one up here on the top looked good for a brief moment, but it didn't take long before we started having gaps down, and this thing is starting to weaken up. Now look over here at the strong angle. Look what happened here. Moving average cross. We're below the averages, and look how strong those angles are. Immediately, they started to take off at a sharp, strong angle to the downside. That's a strong trend. If you will remember this little technique, and I know it's like super simple, it's easy to forget because it's simple, but remember, what is the angle of my moving averages? Are they moving at a strong trend angle or kind of a weak trend angle? One way you can remember this, you don't have to, but one way is the clock rule. Okay, if it's let's do this different colors here. Let's say that you've got a trend that's kind of moving around 3 o'clock. And by trend, I mean you're moving averages. If the lines are kind of moving sideways, you don't have a trend. So we'll put no trend. Okay, if you've got a trend angle that's moving, kind of like 2 o'clock on up. that's going to be a good, strong, bullish trend. If you've got a trend angle, it's kind of moving about, 4 or 5 o'clock on down, any of those angles, that's going to be a bearish trend. Now, what happens if you get a situation where the stock's going straight up or straight down? Well, if it's straight up or straight down, that will only last for a short time because it's unsustainable. So you might make some money on it, but it's unsustainable. And so you're going to have to get out very quick. Okay? This is for my 10, my 20, and my 50 period. You typically will not get that on the 100 and 200 because they're so slow. And yes, I'm using my exponential moving averages. Exponential. Yep, great questions. All right, how about I pull all this together into a basic trend following system? Would that be good for you? Let me give you a basic trend following system. This is a system that makes money as it is. It's not the perfect system, but it is a profitable one, and it is a great place to start. For those of you who are brand new to TradeSmart and you've not gotten to the more advanced classes, this is a great trend following system to start working with in your virtual accounts. And hopefully you'll be able to start making some money with it, and it'll give you some good confidence while you're getting going here. All right, so here's how the trend system works. First of all, you need to know that your key to replicating profits is going to be to have a system. You need to have a system. And the trend is going to be your quickest opportunity to capitalize on a quick profit. So we want a system that's built around a trend, and we want to be able to capitalize on some quick profits. Trend following system is the fastest way to make consistent, quick profits. It's that simple. So the system is for replication. The trend is for quick. You put it together into a trend following system, and boom, now we've got something we can build from. So here's what we're looking for. In the system, we need an entry. We need a tolerance for our risk. We need a way to maximize the profits. And we need a time to exit the trade, or a target for exiting the trade. So let's walk through this here. Using the averages as a basis for the system. The averages are going to be a great foundation for the trend system. They're the trend being the most profitable move in the process here. And what the moving averages do is they're going to allow you to catch the majority of the trend. Please make that note. Your outcome here is not to catch all of it. Your outcome is to catch the majority. You're never going to be able to consistently get in at the lowest low and get out at the highest high. That's not going to happen. You want to catch the majority of the trend. If you're catching the majority of some of those big trends, you're making some money. And that's what your outcome here is to do. All right, so let's look at this here. When the moving average signals a bullish trade, you're going to buy long. When the averages signal a bearish trade, you're going to sell short. That's really simple, right? Then we're going to use the averages to set your stop. You're going to set the average, or you're going to set your stop below the average if you're in a bullish trade. You'll set the stop above the average if you're in a bearish trade. So these are our basic rules here. We're looking for the trigger of a bullish trade. You're going to buy long. Trigger of a bearish trade, you're going to sell short. If you're in a bullish trade, you're going to set the stop below the moving average, typically the 10 period. If you're in a bearish trade, you're going to set the stop above the average. Now, what you want to do is you want to adjust your stop every 2 to 3 days to help lock in your profit. If the stock is stuck and it's going sideways, don't move your stop. Leave it. Don't try to second guess all that. But if the trade is moving in your direction, keep adjusting your stop, either up or down, whichever one is needed. Okay? Then, when the stock breaks through the average, close the trade and be happy. Even if it's not to your target, even if you didn't make every penny you could make, close the trade, give yourself a hug, and be happy. Even if you lost money, close the trade, give yourself a hug, and be happy. Because here's what happens. Once you start breaking below the moving average, all the momentum is stopping. And you don't want to be chasing after that. You don't want to be holding on to a trade thinking, oh, my momentum's going to shift. Don't do that. Please. I got the scars on my back. I got the scars on my legs. I got the scars on my arms. I have done that game way too many times. Don't do it. Once the stock starts to move below the average, if it's in a bullish trade, above the average if you're in a bearish trade, you need to get out of the trade. And you need to take whatever profit you've got. If you don't have a profit, take whatever capital you've got left. And it might be in a week or two, you can get back in. But for the time being, the stock is doing something different than what you want. Get out of the trade. Now, you might make a note. Intraday, you might have some moves below an average, and that's not nearly as strong as an exit signal at the closing price. Okay, so what I'm trying to say is if the stock intraday moves below an average, it's not the end of the world. But if it closes below the average or closes above it, that's a much bigger deal, and you want to pay attention to those things. Okay? Now, let's talk about the confirmations. Here's how we're going to confirm the bullish trade setup. Then we'll look at the bearish one. Confirming the bullish trade setup. The stock has, number one, closed above all three short-term averages. Check. When we close above all three short-term averages, that's the first thing. Next, at least one, if not two, short-term averages have confirmed the moving average cross by crossing up. Check. If you don't have the moving average cross, you are jumping in a little bit early. Third, at least the 10 period is revealing a strong angle up. Check. The 20 and the 50 will lag a little bit, so you want at least the 10 period to be revealing a strong bullish angle. If you don't have that, then you need to wait because you might get stuck in a sideways move. This is the 1, 2, 3 confirmation for getting into the bullish trade based on the moving average trend following system. All right, now take a look over here at this move. We've got all sorts of moving average crosses over here as we're kind of chunking along. But notice how flat that 50 period was. I mean, just no good angles in here. Then finally, watch what happens in here. We start to get above all three averages. Check. And that 10 period starts to take on a good angle. And we had the moving average cross. And we ended up with a move on Apple that went from $400 to over $600 a share in just 4 months. Now, Gene, I know you want to have every penny of that. But if you just had a couple $100 of that per share, would you be happy? I think you're going to be pretty happy on that. I didn't just pull this example out because it was a good one. I pulled it out because this is exactly what a trend looks like. If you just follow this system, it's going to help you. It is a very good system. Now, for the bearish trade, it is exactly the opposite. Here's how we confirm the bearish trade setup. The stock has closed below all three short-term averages. Check. At least one, if not two, short-term averages have confirmed the moving average cross by crossing down. Check. At least the 10 period exponential moving average is revealing a strong downward angle. Check. When you have all three of these happening, you've got a confirmation that the probabilities are very high that you have the beginning of a new bearish trend. Take a look at what happened over here. We have a situation where the stock drops below all three moving averages. We have a moving average cross. We have a very strong angle on that 10 period moving average. If any of you followed this trade, this was Netflix when people thought Netflix couldn't go down. There was a lot of reasons to be bearish in August of 2011 on Netflix that our technical signals told us. None of them were as obvious and as strong as this one right here. Moving average cross, stock is below it. Had you gone short on Netflix, which, by the way, we told our students to do in Power Trader Live that Sunday night, had you gone bearish here, you would have been in a bearish trade around $265 a share. If you just stayed with it on the 50 period moving average, you would have still been in your short trade around $72 a share. That was a pretty good move. Now, if you had tightened your stop a little bit and you had maybe traded with the 10 period, you would have gone bearish around 265 or so. You would have stayed bearish until you break above the trade or above the 10 period at around 225. So you're in up here around 265, you're out around 225. Somebody do the math for me on that. We get back into the trade on the bearish gap down, put our stops above the 10 period. That would have put us into the trade around 210. We'll call it 210 in here. Use the 10 period moving average for your stop. You get out right here around 120. We can go bearish again when we gap down here following earnings. Maybe you would have done that trade. You would have gotten in. You basically would have broken even on that last part of the trade there. So 265 to 225. What was that? $40. 210 down to 120. Unless my brain quit working, I think that's around $90. Yep. And all of that is just following the basic moving average trend following system. Where do we set our stops? I've already told you. I'm going to tell you again. Check your intraday volatility. If you've got $5 that the stock moves intraday, you don't want your stop within that. So check your intraday volatility. Allow room for that volatility. In a bullish trade, you're going to set it below either the 10, the 20, or the 50. I don't really care which one you use. Typically speaking, I try to use the 10. If the 10 period is a little too tight for some for some trends, it will be. Use the 20 period. Recently on my Starbucks trade that I talked to you guys about, the 20 period worked a lot better than the 10 period, so that's what I was looking at there. But if I can, I typically use the 10 period if possible. Now, if you want to be in a longer term trade, go with the 50 period. For the bearish trade, set the stop above the 10, the 20, or the 50. And again, I'm going to let that be your discretion because it's going to kind of have more to do with your personal trading style than it does with the specific, black-white answer here in terms of which one's right or wrong. There's not a specific one. All right. Let's talk about maximizing your profits. Here's some steps that you can use in this system to maximize your profits. Adjust your stops every couple of trading days. With a bullish trade, you're obviously adjusting your stops up. With a bearish trade, you're adjusting them down. That's going to help maximize your profit. When you get ready to end your trade, there's a few ways you can do it. You can close the trade when any of the following occur. The stock hits your stop. That's a great reason to get out of the trade. The stock has traded to your stop. Get the heck out of Dodge. All right, the next reason. If the trend starts to slow down and your averages start to move sideways, sometimes the trend will start to go slower. Like, for example, right here. If you were trading and you were setting maybe the 50 period for your stop, and then you start to see that, man, things are slowing down, just go ahead and get out of the trade. You don't have to wait for your stop to get hit. If you have reason to believe that it's going to maybe slow down, the averages start to move sideways a little bit, well, just get out of the trade. You don't have to stay with it forever. So stock hits your stop. That's one reason. Trend is slowing down. The averages start to move sideways. That's a great reason. You get uncomfortable. What if you're in a trade, everything's going well, it hasn't reversed against you, but you're just feeling uncomfortable and you feel like, hey, I'm ready to close my trade. That'd be a really great reason to get out of the trade. This happens a lot, especially in a strong trend. If you're in a strong trend and the stock has gone a long, long way, it may not look like it needs to reverse, but your gut might kind of say, yeah, this is starting to feel a little uneasy. I want to close it and take my profit. That's a good reason to do it. Even though it may not have any reasonable sense to do it, there's no reason not to take your profit if you're happy with it. Then here's my final reason: your price target's hit. This is the ideal one. My favorite reason to close a trade is when it hits my price target, because that means that it has traded to the target that I wish to trade it to. And by golly, take my profit and turn around and go home and do it again, right? So that's how you're going to get out of the trade. All right, let's talk about the weaknesses of the system. Every trading system has weaknesses. As I've already mentioned tonight, the moving average weaknesses are the sideways market. Be aware of sideways markets. Anytime a stock is doing this, it's a pain, and the moving averages are not very helpful. So how do we avoid a sideways market? Well, here's how we can start. There's never a guarantee. You got to know that. This is the weakness of the moving average system. So there's no guarantees, but we can take some steps towards it. Number one, do your best to ensure that the averages are indicating a strong angle. If they're going sideways, it's not got a good angle. You want to avoid that. Pair the system with additional technical analysis, such as your line drawing. This is really important. This is part of my 5 steps to trade confirmation. Pairing the moving averages with other systems. And then, of course, continue developing your analysis skills. As you start to learn more and more about analysis, you'll be able to avoid some bad trade setups because you'll be able to recognize them. Signals that you wouldn't have seen on the average system, you'll start to recognize maybe with your candles or another type of a system that you can pair in here with it. So continue developing your analysis skills. That's a good way to help avoid the weaknesses of the system. And then finally, put some faith in your system. Test it and trust it. Once you've proven it to yourself that it'll work, by golly, you got to believe your system. Test the system in your virtual account. Prove it to yourself that it will work. And then, of course, knowing the results of your testing and having the faith in that. That's another way that you can feel a lot better, and it will help you avoid some of the weaknesses. Because what will happen is when you get into those weak moments in the system, you'll start to lose faith, and then it'll break into that big life-changing trend, and you didn't believe it, so you missed the trade. Again, those are scars speaking. So, just put your faith in the system and recognize it. Once you start to see the signals, take a little bit of a risk and give it a shot. All right, that's all I've got to teach you on moving averages. If you can hang with me for a few minutes, I'd like to teach you a couple of techniques in terms of blending the averages with your line drawing, because this starts to kind of pull it together into something that it's more practical, and the moving average system is super practical, but this was just a little bit stronger when we can pull the two together. So let's look at how this would work. The challenge of the moving average is the fact that you don't have a framework. And that's exactly what the line drawing does for you. Line drawing gives you a framework, tells you where the stock should be trading. The moving averages tell you the momentum. They show you when the trade is getting confirmed. So let's use our line analysis for our framework, and then we'll use our moving averages to help shape the trend. And together, our lines and our moving averages will give us a really powerful setup system. So you're running into support and resistance. When you're running into support and resistance, you got the structure set up for your price targets. This is all great stuff that your line drawing will give you. This is the information you can take from it. If an entry point works really well based on your line analysis and your moving averages, well, the odds are very high that it's going to be a pretty decent trade. So you got to remember that. Hey, if it looks good on the line chart, that's one thing. It looks good on the moving average chart. That's another thing. If it looks great on both of them, this is getting some pretty high probabilities that this is going to be a winning trade. Those are the kind of signals that you're looking for. Take a look over here at this trade on Hess. Notice what happened. If you look at this trade, you can say, okay, I've traded up into resistance and I started to pull down. Well, that was a pretty obvious bearish move. Down here at support, we've run into support. We've got a inverted head and shoulders, if you know what that is, which is happening at support. That's a pretty good signal there on a line chart, but it doesn't tell us about the trend. Well, now let's take a look over here at the moving average chart. On the moving average chart, oh yeah, we had a really strong confirmation of a bearish trend. You put those two together, that was a really good, strong confirmation. Now watch this. Put them together. We're pulling away from resistance. We got the moving average cross. There's a bearish trigger. We trade to a target. The averages are still strong. Trade to the next target. Now watch this. we're starting to move sideways, and look at how the averages are starting to flatten out, there's your really strong exit. And it just so happened that that was the end of the move. So this is a really great example of how combining your support and resistance and those averages will give you a stronger system. Does that make sense? What do you think of that, Gary? Is that a system you could get behind? That's starting to put some kind of, tires getting rubber on the road here. Yeah, let me give you a checklist here. Here's your checklist. Bouncing on support or resistance? Question mark. If yes, if it's bouncing up, you're bullish. Bouncing down, pulling down, you're bearish. Do your moving averages confirm the move? Yes or no? Are we above the averages, below the averages? Moving average cross, do we have a good angle? These are the questions you want to ask as you put the two trading systems together. And of course, the line drawing is not a system as much as a framework, but as you take these two analysis tools and put them together, we're looking to be bouncing up from support or pulling away from resistance with your lines, and we're looking for the same type of a move happening with your moving averages. We're going to exit when we hit our target based on our line drawing, or the trade hits your stop. That's really the typically that's really when you're going to exit. All those other reasons I gave you earlier, those are good, but honestly, if you just do it when you hit your target or this trade reverses and you get stopped out, you're going to be pretty good in this following system here. All right, let's get over to Trade Navigator. I realize it's a little bit late. I went a little bit long here. You want me to go ahead and give you some homework, or are you guys good for me to do some chart analysis here? You good for me to keep going? Okay, I'll keep going here. So getting over here to Trade Navigator, I can show you pretty much any trade, any trending system, any trending stock will work with this system here. Let's start here with the Dow Jones and just look at some of the stuff that's happened recently. One of the signals, excuse me, one of the signals we had a couple of weeks ago, about a month ago, is we had all three of the averages crossing bearish, and look at these strong angles. I mean, this sucker just took off. Now, how did I know to get out down here instead of staying with it until we bounce back up here? Well, you don't based on this picture, but if you put your lines back on here, voila, look at that. We started trading down to these support levels, and I combine a third technique, our candlesticks, long lower shadows at support. Yeah, that's time to be tightening your stops. That's when I'll leave the 10 period and I'll come on down here and I'll be putting the stops really, really close to the trading price action and locking in my profit. Okay, so that's an example there. Somebody has mentioned they'd like to look at Tesla, so we'll look at Tesla real fast here. Tesla's not one I trade a lot, so this will be interesting to look at it here. As we look at Tesla, we can see that some of this momentum has started to shift. Let me zoom out. Again, I don't trade this much. I do have some lines on here from various things that we've looked at. But as you look at the big picture, we'll start with the big picture, the 200 period. Look at this. The 200 and the 100 period show Tesla in a strong bullish trade. Now look at what else has happened. Look at how the 200 period has really been support most recently here in October. So even though the short-term averages are showing reversal, the long-term averages are providing that support, and these two are a little bit of a competition in terms of who's winning. Short-term average-wise, we're in a bearish trade on Tesla. No questions asked. We got the moving average crosses happening here. We're below the averages. All I would want to see from here is a bearish breakdown. This thing starts to trade bearish. I'm going to be pretty bearish on Tesla just on this picture alone. Now, without having spent a lot of time doing line drawing on here, I can snap a couple lines in here and tell you that that's a major pivot area right there. I can just see that one. Looks like we're going to have one up in here. Yeah, there you see that happening. We'll throw one up here at the all-time high. So you got some structure there. Later, you're going to learn about chart patterns. Tesla's also got this head and shoulder pattern. That's a big deal. It's already broken the neckline. It's coming back up to test it. On Tesla, I can tell you what the next trade is. Put a little trigger in here about 230. If this thing breaks down, breaks bearish below about 230.75, you can trade it. We're going to trade probably exactly to 216. We'll probably stop there for a little bit, and then it will most likely continue to about 175. That would be my general prognosis. Looks like we've got earnings coming up on November the 5th. So that's next week. You probably do not want to trade this until after earnings. Otherwise, it could be a gamble, and you could get hit pretty hard on that. All right, so there's a look at Tesla. Robert wants to look at Amazon, so I'll look at Amazon here. Robert, Amazon has been in a clear bearish trend for many, many months now. Even in the face of ongoing bullishness in the market. We really started this back here in February. We had a big bearish gap down here. And look at the moving average cross. We kind of crossed back up here, and then look at the re-entry opportunity that we had. If you were in Power Trader, you remember that. Around 365. Another entry was at 352. You see that because we were below support there. And we had several targets on the way down here. We slowed down here. We slowed down here. Ultimately, we made it all the way to our bottom target. Once we made that move, that was a move from 365 ultimately to 283. We started to bounce out of there. Probably did not get out at 283. You probably ended up stopping out somewhere up in this range, but it was a great trade. We had a little counter move. Then look at what happened back here in September. I started putting bearish trades on Amazon back here in September. First entry was 322. And then after earnings, we gapped all the way down to our target. And now we've retraced a little bit. But notice we're still below all three moving averages. I can't be bullish on Amazon right now. Even though I would love to be. I love the company. I love buying stuff from them. The stock's just telling me that, hey, this is a bearish trade. Now we're in a retracement. We've moved from 283, 284 up to about $300 almost. And we may retrace on up to about 311. That is possible. But I have a rule. I try not to trade counter trends. Sometimes I get stuck in a counter trend, and I didn't mean to. But I typically try not to trade counter trends, and this looks like a counter trend, so I'm going to try to avoid that. What I'd be watching for on Amazon is along the 10 period, the 20 period, or this resistance up here at 310. What did I say? 311. Right at any of these 3 points, if you start to see candle signals that tell you to move bearish again, that's when you should start to consider the return to bearish trades. Now, for those of you who are new and I've not taught you candles yet, I'll get there. That's part of level 2, and I'll teach you about the candle signals to help you out there. All right, let's do another one on here. Let's look at Apple has continued its bullish move, so let's look at some bullish trades here. Notice what happened with Apple following its well, I don't have it marked as an earnings, but I'm pretty confident this was the April earnings back here. Actually, I remember it being April earnings. And so we gapped out because we'd been kind of in this triangular pattern back here. We gapped out, and notice what happened. Moving average cross, boom, we're in this nice bullish trend. Look, we've been above the averages the whole time. Now, if you set your stops pretty tight above or below the 10 or the 20 period, you got stopped out a couple of times, and you could re-enter the trade. But then watch what happened. We got into a little wedge up here. We had a new gap out just a week and a half ago, moving average cross, and right now, Apple is still a bullish trade. Look how far these 10, 20, and 50 period moving averages are separating. Look at the angle. Now, taking a look at that angle, how long do you think that angle can last? It's probably not going to last at that angle forever. It can go for a little while, but you're already starting to see some counter moves starting to come back in. I probably would wait for Apple, see if it comes back down to your 10 period and then continues. I think we've gone quite a ways on this trade, and I don't think it's ready to continue yet. We'll have to watch that a little bit, but that's getting into some more advanced analysis there. Let me think through here if there's anything else in here I wanted to look at. I think that's a pretty good cross-section there. Home Depot, this is another one here. You can see some of the trades we'd set up here. Had a trigger at 95.57. Moving average cross came along and confirmed that. That was all great. Breaking out above. This is a question a lot of students ask. How do I know when I'm trading in uncharted territory? When you're in uncharted territory, how do I know where my target is? This is a great example on Home Depot. So here's what you're going to do. If you're in this Home Depot trade, you can just set your stops right below the 10 period and just keep trailing up with it. And then when you get a candle signal, and again, if you're a new trader, you don't know your candlesticks yet, but I'll teach them to you. And when you start to see a candle signal, such as this bearish engulfing that tells you the trade could be done, you can tighten your stop or just close it, and that's usually where it's going to stop. So those are the kind of things you want to be watching for there. All right. All right, ladies and gentlemen, I think we've had a pretty good class tonight, pretty full class. How many of you feel like you got a tool after the end of tonight's class with your moving averages, some checklists, a moving average trading system, support and resistance? How many of you feel like you got a tool that you can now go to your virtual trading account and start really working at trying to make some more logical trades? And hopefully you'll even start to see some profits maybe before the class program here ends, and you get some confirmations that, hey, I'm going in the right direction. Don't do this in your real account yet. I'd rather see you practice it. And if you'll practice it, then you're going to learn some stuff that, I can't teach you. Only experience can teach you. And if you'll do that, I think you're going to be a little bit happier. But I gave you some really, really valuable tools tonight. You might need to rewatch the video. I'll post this teaching up to the website after I get it rendered up here. It'll be up in maybe, give it 7 or 8 hours. But this is a system that will work for you. And part of the redesign of level 1 that I wanted to do is I wanted to give you tools that as you get in here, immediately you can start putting some of this stuff to action. By the time we're done with level 1, I wanted you to have something that you could start making money with. And so this is a system, and it's a profitable system. I think you guys will really enjoy it as you start to work with it more. Here's your homework. Set up your moving averages in your charting software. Review your notes from tonight's class. Do the online quizzes. Those are no longer there. We got rid of those. We're doing something different. Forgive me, I forgot to get that out of there. Those online quizzes are not there anymore, so forget that. Place virtual trades and using your moving average trend following system as we have discussed. Ladies and gentlemen, I love and appreciate all of you. I hope you have a wonderful night. I'm going to call it a night. Before I call it a night, I want to answer Leon's question. He says, when are the Stock Market Made Simple classes taking place? We don't teach that program live, Leon. I never have taught that program live. Those lessons are available in your membership area. They should be in your account. If they're not for some reason, reach out to, you can reach out to almost anybody, but probably the fastest response is either going to be info@TradeSmartU. And you'll find Andrew on the other end there. That's kind of our generic customer support email address. And then the other one you can contact, Leon, is Michael at TradeSmartU.com. And Michael's just, he is a student success coach, and I believe that he is your student success coach. And Michael will really hook you up. If you got the time to set up a phone call with Michael, Leon, that's the one you probably want to talk with. But if you just need a quick email, send Andrew an email over at info@TradeSmartU. Okay? Yeah, I really encourage you guys, use Michael. I mean, that's what he's here for. Set up your phone calls. You need help navigating the website. You need help understanding anything. Michael is here to hook you up. So set those phone calls up as you need them, and please do that. All right, you guys have a wonderful night. Have a great weekend. I'm sorry I only had one class for you this week, but we'll resume our bi-weekly schedule starting next week. On Tuesday night, we'll get into class number 6. Until then, have a great weekend, and I'll see you guys Tuesday night. Good night.